Ladies and gentlemen, good day and welcome to Kirloskar Pneumatic Company Limited Q2 FY26 post-earning conference call hosted by Antique Stock Broking Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Amit Shah from Antique Stock Broking Limited. Thank you, and over to you, Mr. Shah.
Thank you, Hina. Good afternoon, everyone. On behalf of Antique Stock Broking Limited, I welcome you all to 2Q FY26 post-earnings conference call of Kirloskar Pneumatic Company Limited. To discuss the results, we have the senior management team of the company, represented by Mr. K. Srinivasan, Managing Director of the company, and Mr. Ramesh Birajsar, Chief Financial Officer of the company. I would request Mr. Srinivasan to give us the opening remarks, post which we can open the floor for Q&A. Over to you, sir.
Thank you, Amit. And good evening to all of you. Let me say greetings for the Diwali festival season. May the festival of light bring us all a brighter and clearer future. Thank you all for joining the call today. I know there has been a significant level of disappointment, and I think we have a strong reason to explain what we have done and how we are going to do better going forward. I have with me Mr. Ramesh Birajsar, the Chief Financial Officer, who will be able to explain the numbers. And of course, I have Mr. Jitendra Shah, the Company Secretary and the Chief Compliance Officer. Before we proceed with the business updates, can I request Jitendra to read out the disclaimer statement, please?
Thank you, sir. And good evening to all. The presentation uploaded on the website of the company and discussion on the financial results during the earnings call may contain statements relating to future business developments and economic performance that could constitute forward-looking statements. While these forward-looking statements represent the company's judgments and future expectations, a number of factors could cause actual developments and results to differ materially from expectations. The company undertakes no obligation to publicly revise any forward-looking statements to reflect future events or circumstances. Further, investors are requested to exercise their own judgments in assessing various risks associated with the company and also the effectiveness of the measures which taken by the company in tackling them, as indicated during the discussion. Thank you.
Thanks, Jitendra. So let me proceed with the business updates. We had a quarter that was challenging on all fronts, in order booking, in sales, as well as in execution, making it a rather poor H1. For the first time in many years, our order booking, sales, and profits were lower than the corresponding period of the previous year. Sales in H1 was at rupees 665 crore as against 706 crore of the previous year. Most of the execution challenges came from package to be shipped both in refrigeration as well as packages for the CNG stations. Domestic market was muted with various uncertainties causing delay in project clearance and approvals. Export sales at 31 crore was also lower than the 43 crore of the previous year H1. Order booking was most impacted due to the underlying uncertainty and churn, particularly in the oil and gas space, and this left us with an order book of rupees 1,667 crore as on 1st October as compared to 1,624 crore on 1st April 25, significantly below our plan. The mitigating factor in all this has been the finalization of a couple of large orders which will utilize our unique manufacturing capabilities that we had recently set up. We will book these orders in Q3. We also expect that some of the delayed decisions will now be cleared, giving us the much-needed order bank for the next year. We gainfully utilized this period of uncertainty to commercialize many of our IPs. The Test Catalipuka centrifugal compressor has quickly established itself as a product to beat in its space, having crossed the 100 mark. We now have an order of 115 compressors this year, and of which we have done about 88 of them so far. We still have 27 to go. Janus D range of specialty motors and our new screw compressor as well as the Taichi semi-hermetic compressors have both had successful launch. We should see them scale up in the next quarter. Our subsidiary company, Systems and Components, where we have 55.26% holding, too had a muted quarter. Sales was about 9 crores and they became profitable for the first time in many quarters. We expect them to grow from here with increased market presence and support from the parent. The net working capital was at rupees 202 crores. This is significantly lower than the rupees 316 crores the same period last year. This is on the back of strong receivable management and significant advances from the customers. CapEx spent was at about 28 crores. We expect to have a total CapEx spend of 90 crores during the year. Free cash generation from operations in H1 was 143 crores. Now let's discuss the result by product lines. The air compressor business had two bright spots. The test Catalipuka centrifugal compressors as well as the reciprocating compressors for CO2, which is co-generated in the ethanol industry. There was a general slowdown in the finalization of orders across industries except cement and metal. With our new Janus D-based screw compressors coming to the market, we expect to take market share in the next couple of quarters. Refrigeration compressor and systems. The refrigeration compression segment was also running at 2 speeds. The large projects were running slow, plagued by uncertainty, while the food and consumption-driven business was booming. Here, our Q&A packages was the star, winning orders across pharma, dairy, fisheries, concrete casting, et al. The ammonia reciprocating compressor continued to rule the cold chain and ice plant space. The Taichi semi-hermetic compressor was a new kid of the block, immediately taking market share from imports. We expect this to scale up rapidly and take most of the 1,000+ compressors that are currently being imported from Europe. In a significant move, the board cleared filing an application under the production-linked incentive scheme for entering the commercial air conditioning space with our unique Zephyros C system. The commercial air conditioning market in India is over 5,000 crore and we expect to address a significant share of this with our efficient and economic solution. This will be a completely indigenous product. Once approved, we will commission this project in 18 months. Gas compression system. The oil and gas sector globally has been going through a period of unpredictability that has come from multiple reasons. Technological changes, energy transition, as well as the geopolitical uncertainty. As a company, we have learned to work with all this. We offer upstream, midstream, and downstream compression packages, CNG distribution systems, biogas packages, hydrogen packages, etc. Yet with all this, both order intake and execution remained a challenge in H1. We continue to get orders for packages, CNG stations, and booster stations, but clearly this has been slowing down quarter on quarter for nearly 2 years now. We don't see this improving in the next quarters either. The only redeeming feature in this space has been the pickup of export orders for CNG packages to the MENA region. Both biogas and hydrogen are still to scale up to any significant value. Export has never been a part of our strategy to grow in this phase of our growth. Consequently, we are not impacted by all the churn in this space. We expect to have about the same export of last year, that's about 124 crores. The tie-up with PDC Inc. is offering comprehensive solution for hydrogen and other difficult-to-handle gases has helped us to win a couple of packages. With changing priorities in the US, India and Asia seem to be a more attractive market for hydrogen packages, and we expect to see more activity here. The O&M service business continues to grow with the install base growing. However, we did take a hit of 2 crores as write-offs on account of bad debts in this quarter. Outlook for H2 FY26. The industrial activity in India has slowed down in several sectors and it does impact both the demand as well as sentiments. CapEx spend, except in few government-led sectors, is still very hesitant. Yet in all this, there are some clear areas of investment and growth. Domestic consumption as well as a secular trend of localization of supply chain. The two strategic choices that we made a couple of years back stand us in good stead. 1, focus on domestic market and look to export only after we pick up size. And 2, manufacture in-house as much as we can using technology as a differentiator. We have finalized a couple of large orders based on our manufacturing capabilities. With the new launches and this manufacturing capability-led business, we expect to more than catch up in H2. We will deliver a strong double-digit growth this year and will do even better in FY27. The commercialization of various IPs like the Zephyr C and entering the large commercial air conditioning market should ensure that our aspirational growth targets will be met. Now I will request Ramesh Biraza, the CFO, to take you through the financial aspects first. Thank you. Ramesh.
Thank you. Good evening, everyone. I trust you must have reviewed the Q2 and H1 FY26 financial results, which are published promptly on the BSE and NSE website following our board meeting. A comprehensive presentation detailing these results is also available on company's website. For your convenience, I would like to provide summary of our performance for the second quarter as well as the first half of fiscal year 26. Sales of Q2 FY26 were higher compared to Q1 sales of current year. Sales at 378 crore, it registered a growth of 37% compared to Q1 sales of 272 crore and compared to Q2 FY25 sales of 431 crore. The H1 FY26, the sales were at rupees 650 crore compared to 706 crore of H1 FY25. Other income for the Q2 FY25 was at rupees 6.8 crore, which is almost like rupees 6.2 crore in Q2 FY25, while other income for H1 FY26 at rupees 15 crore, which is higher than H1 of FY25, which is of 10.6 crore. Material cost for Q2 FY26 was at 52.1% compared to 51% in the corresponding quarter of the previous year. For H1 FY26 and H1 FY25 remains the same. This is due to better product mix, package sales of our air conditioning and refrigeration division in Q2 FY26. The split between the packages, which is around 33%, and the product of 67% orders contributed to maintain the material cost at a reasonable level, and we expect material cost to remain same in the remaining period of the year. ERE increased to the extent of increase of manpower and impact of salary revision from April 25. During the year, deserving employees were granted increments aligned with the prevailing industry trend. As a result, the H1 cost for FY26 stands at rupees 97.4 crore compared to 87 crore in corresponding period of FY25. There is no interest cost relating to any borrowing either for Q2 or H1. As a result, the company is a debt-free company. I would like to state that company has a net cash and cash equivalent position of rupees 424 crore as on 1st October 25. During H1 FY26, the company incurred capex of approximately 29 crore and paid dividend of almost rupees 42 crore. No big change in depreciation. It is aligned with the asset addition. Regarding other expenses, we have observed a mix of both fixed and variable costs. There has not been any significant variation in the level of expenditure during the current quarter compared to the previous one. The strategic investment made by the company in installing solar systems at all our locations is now yielding the benefits. It is evident as the power costs have remained consistent despite increase in the activity at our Nashik location and plant 2 in Saswat. EBITDA at 17% in Q2, which is up from 15.7% in Q1 of FY26. For H1 FY26, EBITDA is rupees 109 crore at 16.4% compared to 20% in H1 FY25. PBT of rupees 57 crore at the rate of 14.8% for Q2 FY26 against rupees 92 crore in Q2 FY25 at the rate of 21%. PBT of rupees 94 crore for H1, while PBT of 128 crore in H1 FY25. Higher profit in H1 FY25 was despite of large package in Q2 FY25. Consequently, PAT is showing a similar trend in Q2 and H1. PAT, that is profit after tax, in both Q2 and HY, with the PAT reduced from 94 crore in H1 FY25 to rupees 71 crore in H1 FY26. Company issued 17,700 equity shares in H1 under its employee stock option program. Previous year, 68,200. Consequently, paid up share capital increased marginally as compared to the beginning of the year. Basic EPS for H1 FY26 is at 10 rupees 98 paise as against rupees 14.57 per share in FY25. With over 91% of revenue is coming from our compression segment, it remains the only reportable segments, and the segment profitability in Q2 is at 20.3% and in H1 at 19.5% as against 25.6% in Q2 FY25 and 23.1% in H1 FY25. Company has an order board of rupees 1,667 crore as against 1,624 crore at the beginning of the year. Capital employed in the compression business reduced by 78 crore, reaching to 258 crore at the end of H1 FY26 compared to 333 crore at the start of the year. We have regrouped, rearranged the financials wherever it is necessary. We have published the consolidated income statement, which now includes the newly acquired company system and component. Comparable financial details will be available only after completion of full year in the reporting cycle. Now this forum is open for discussion with our esteemed investors. Amit?
Anyone out there? We cannot hear you. Mr. Amit Shah?
We can open the floor.
Open the forum for the discussion, Q&A.
Okay. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Priyank Chheda from Vellum Capital. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Just on the business scenario, versus the 23rd July, when we had a call for the last quarter, you called out for 500 crores of sales in Q2. In fact, if you see the business environment has improved since then, what would be the key factors that you would want to point out for the performance, which has been way below than your own internal targets?
Yeah, thanks for this question because I think this is an important question to answer. We had 3 reasons why we think the business has not performed to the level it should have. One, there has been a structural change that is happening in the process gas business, particularly in the gas distribution side. We seem to have lost market share in terms of the CNG packages and the boosters. We seem to have not got enough clearances, and we always thought that's because the site's not getting ready. I think it's more than that. And that's the reason also when I said that we did take a hit of whatever old payments that we didn't make, because I believe there is a clear down trading in this sector where they have all gone down to cheaper products and they are acceptable to them. So first is there is a sectorial change, and there we have to look at how we can make ourselves more competitive. That's the first one. That is our poor call judgment of what is happening in the market. The second one is there is definitely a hesitancy in terms of giving clearances. I gave an example of test catalytic poker. We had an order for 115. About 27 is still under manufacture, which means really we're not getting enough clearances of drawings, approvals to even complete the packaging. 88 have been delivered, and out of that only 46 have been commissioned. The rest of the 42 are just lying at site without even commissioning, which means while we say the business environment is better, not really showing up in terms of project execution. Even where you push and deliver to them, the projects are not getting started. So they're all standing at site. So overall, there is definitely a slowdown in project execution. That's the second one. The third one is new projects or projects is where bulk of the changes or lack of clearance is happening. If you look at general engineering, consumption-driven space, where we look at, let's say, air compressors, the demand is reasonably okay. So the general consumption-driven things, there is some activity going on, nothing big has changed. That seems to be happening. Here, our market share as it is very low, 5%. And there we seem to have getting orders. It's not that there is no orders there, so that seems to be running okay. But the clear big difference, I would say, is one, process gas system not doing as well for us, so there's a loss of market share. Two, we definitely have a slowdown, particularly in project execution. That is probably hurting us more than what it would hurt others who are driven by consumption-driven business.
Very clear. And for this, maybe the suggestion has been floated around if the three segments which we report, which is ref, air and gas, if we start giving out the quarterly revenues right upfront in the presentation, it would answer a lot of such one of the few turning points that you are trying to highlight. Yeah, thank you for that. My second question is on the new launches. I think we have high hopes on Tesla, Kipoka and Kiano packages. So would you want to just highlight on in terms of how has been the sales over last 6 months on these new launches? And when you highlighted on the Tesla, Kipoka, where 42 are lying at your site, would it be fair to say that...
Customer side.
Okay, at the customer side. Okay, so but the revenue has been booked for 80, right, out of 115?
Everything that is billed and shipped out, the revenue is booked. 88 have been shipped out and that's been booked.
Okay. Got it. So the question was on, in overall, the new launches and their performance over last 6 months.
Yeah. So, like I said, the test catalytic poker clearly is a winner. It is probably the industry standard now. People have accepted it as the product to beat. So we can only see as projects happen more frequently and more projects get cleared, this will scale up. We talked of first saying that this is a market of about 300 crores or so. I believe it can be even bigger and more market share will come from this product. There is only at the moment 4 range that we make. We make 2,100, 3,500, 500 and 7,000. We don't address the full range of centrifugal. We will try and increase that during the next batch of production. So that's broadly what we'll do on test catalytic poker. Kione is got well established across all the industries. We talked of pharma, dairy, fisheries, and all these are picking up. So Kione packages also will continue to grow. We'll expect to do at least about 50 packages this year.
Got it. And one last question before I come back in the queue. The order book for the last quarter, last year, September, is somehow, I think, has got restated to 1624 versus the last year it was 1780. So maybe a clarification on that. And, sir, on your side, what would you like to revise the guidance for FY26 and beyond? Maybe there are interim jerks, but would you want to restate that starting FY27 or starting next quarter? How should we think of the performance versus the original guidances that you would have been you are giving us? Thank you.
Yeah. So as far as the guidance is concerned, as far as this year is concerned, we will get to very near a 15% plus growth for the full year. You will see in between Q3, maybe the growth is even higher because we had last year a poor Q3. But then for the full year, we have taken that definitely about 15% growth on top line. and correspondingly, because the business ratios have not changed, so the profits will also grow by and large about 25-30% based on what we'll do this year.
And on the order book, which has got restated,
order book got restated.
No, order book 1,624 crore is the correct, which is at the beginning of the year. So 1,624 to 1,667. This is the 6 months of the period what I given to you in the presentation. So 1,600 is the correct, which is starting. That is the opening order book as on 1st April 2025.
But your concern on order booking overall still remains. See, I must clarify that while we are giving you the total orders on hand compared to last year, we expected to book significantly larger number of orders in Q2 compared to what we actually did. We are not happy with our current position, and we expect some larger orders to be finalized in Q3. As I speak, I know that there are some big orders that are finalized, but it's not in my hand, so I will still not talk about it till it is done.
Thank you.
Thank you. The next question is from the line of Rishabh Shah from Bugle Rock PMS. Please go ahead.
Hi, thank you for the opportunity. Sir, my question is, in the previous years, we have guided that our exports will be in the range of 15 to 20%. But we haven't crossed the bit 10% for many years. We just wanted to know what gaps were left from our side that we couldn't achieve our targets, and any process in place to fill those gaps so that we can reach our target.
Mr. Shah, I think in the last at least 4 or 5 years of all our calls, you will see we have been saying export is not our focus area. We will try and be even a global company operating primarily out of India and Indian market in this phase of our growth, and we will talk of export being important once we come to a significant size and scale. We always said that export will never go beyond double digit. It's single digit, it will be around 7-8%, and that's where we are. I think there could be some mistakes in understanding. So I'll repeat again, export is not a strategy for us at the moment. There are only few markets that we export to, and that is largely the MENA region and Southeast Asia. The best export we did was 177 crore. Last year it was 124 crore. We have always been saying that we'll do about the same this year as well.
Okay. So my next question is, what percentage of revenues come from the aftermarket sales? Since it is a very high margin business, so are we taking any steps to further increase aftermarket as a percentage of
here again, I will,
revenue?
But here again I'll clarify. We've been saying in several calls, aftermarket margin and original product margin for us is about the same. We don't do any very special pricing on spares, etc., compared to other competitors who predominantly sell import-dependent capital goods. Consequently, they have to make their margin only on spares and service. Our margins are about the same on both. The second thing is we said sales and service combined is about 15% of our total turnover, and that broadly remains the same. That has not changed either.
Okay. And so, next question is on, we have said that the refrigeration side of business is 100% all imports, and it is a 3,000 crore market. So, any steps on that side to gain maximum market share? Because 3,000 crores only for refrigeration is a huge market for Kirloskar Pneumatic.
So let me again clarify. The refrigeration and air conditioning as a segment, what we report, is today predominantly